Natural gas futures snapped a 4-day losing streak on Friday, with July contracts climbing 2.55% to settle at $3.58. The rebound was fueled by escalating geopolitical tensions and weather forecasts hinting at stronger short-term demand. Traders responded to a sharp uptick in European gas prices and renewed concerns over global LNG flows, lending support to prices despite persistent supply-side pressures. A 6% surge in European natural gas, sparked by Israel's military strike on Iran, set the tone for the rally. Markets are increasingly factoring in geopolitical risk, particularly the potential for disruptions to LNG shipments through the Strait of Hormuz, a critical choke point that handles around 20% of global LNG traffic. Adding to the bullish sentiment, Israel's shutdown of the Leviathan gas field halted pipeline exports to Egypt, amplifying fears of tighter regional supply. Forecasts calling for widespread above-normal temperatures across the U.S. from June 23 to 27 added further upside potential. Analysts projected a surge in heat levels likely to drive increased air conditioning use, boosting natural gas demand for power generation. Although current consumption remains relatively muted, this anticipated weather-driven demand could help tighten the market balance in the near term. Meanwhile, supply continues to outstrip demand. Recent data shows U.S. dry gas production averaging 105.4 billion cubic feet per day, up 3.2% year-over-year, while total demand has slipped to 70.3 billion cubic feet per day, down 5.2% from the same period last year. LNG feed gas flows saw a modest uptick to 13.8 billion cubic feet per day. Additionally, data from the Edison Electric Institute reported a 2.7% year-over-year drop in U.S. electricity output for the week ending June 7, dampening some of the bullish sentiment tied to upcoming heat-driven demand. Near-term sentiment remains cautiously bullish, largely dependent on confirmation from either geopolitical developments or weather-related demand spikes. That said, the broader midterm trend continues to lean bearish. The key question heading into next week is whether bullish speculators can drive prices higher on the back of escalating tensions between Iran and Israel. From a fundamental standpoint, the justification for a sustained rally is weak. Iran is a relatively minor player in the global gas market, exporting just 16 BCM annually, primarily to neighboring countries such as Turkey, Iraq, Armenia, and Azerbaijan. As such, the impact on global or European gas markets is expected to be negligible. Ironically, if the conflict escalates and oil prices surge toward $100 due to potential disruptions in the Strait of Hormuz, it could have a bearish knock-on effect for U.S. natural gas. Higher oil prices would incentivize more domestic oil production, leading to increased volumes of associated, byproduct, gas, which could flood the U.S. market and push prices below $3 over the medium term. In this context, even if bulls manage to lift prices toward the $3.80 level, it would likely represent a short-lived, speculative spike rather than a sustained breakout. What's your take on how the Iran-Israel conflict might impact oil and gas prices? Share your thoughts in the comments. Please like, subscribe, and comment to support the channel. See you in the next one.